Hello, fellow Repo Capitals. Hope you're well. So we have something very interesting brewing in the repo market. So we've got to not just look at the repo market, but we've got to combine this with everything else that's happening in macroeconomics that would pertain to an anomaly, which is exactly what we have just seen, and try to connect some dots. So let me do a quick screen share, and I'll show you exactly what I'm referring to. There we go. We go over to a Fred chart. Oh, that's not it. That is a Fred chart, not the one I'm looking for. Here we go. So this just happened right here. Just happened yesterday, a day prior. And it's unusual. Now, the first thing that comes to mind is it's just end of the month. It might be end of the quarter. But you look at the other ends of months and other ends of quarters, and they don't spike like this. Now, this isn't signifying the total repo market activity by no stretch. This is just simply the repo transactions done with the Federal Reserve. So you have to ask yourself, okay, they're likely going to pay a higher interest rate. If they do a repo transaction with the Fed, it's not going to be as easy. It's going to be a little more cumbersome. So why? Why would you do that? Well, there's a reason why, because you're having to pay way too much in repo. And why are you having to pay way too much? Because there's counterparty risk, right? I think a lot of people would argue, well, there's just not enough bank reserves, but I have a hard time buying that because I don't really think the banks need bank reserves to actually settle. I don't think they need bank reserves to do a repo transaction. So now let's zoom out, because when we zoom out, this becomes a lot smaller. So then the question becomes, okay, is this something just minor? Is this a one-off? Why did it happen? Or is it something that is giving us a signal as to something happening beneath the surface that could turn into a significant issue? So let's do a 5-year chart. No, let's do a 10-year chart. There we go. So this is when we had the last repo blow up. You guys remember that, 2019 September, and things just went completely haywire. And there was a lot of usage with the Fed's repo facility. I think they call it standing repo facility. And then we go into the cerveza sickness, and then they basically start QE infinity. Things calm down. We have the fiscal component come out. Market starts to rebound. Liquidity comes into the system because the banks are more willing to lend, because they're confident by now that the world isn't coming to an end. And so they're not going to use the Fed's repo facility. They're going to use just the market version. So this makes a lot of sense. So you have to look at this and say, okay, well, is it a red flag? Absolutely. No doubt about that. Because even if you want to argue it's end of the month or end of the quarter or taxes being paid or something like that, it didn't happen here, right? It just had a little blip right there. And so you can't ignore this, is what I'm saying. But we're not at the point now where we were in September of 2019. But it's not to say that this isn't the start of something like that. And here is where I'll layer over other bits of information, because you can't just look at this chart by itself and say, oh, well, I know what's going on. You have to say, okay, well, what's happening with other interest rates that could be giving us clues as to why there might be a lack of dollar liquidity or a lack of willingness to lend to specific counterparties in repo. Therefore, those counterparties have no other choice but to go to the Fed. And again, a lot of people blame this on there's just not enough money. That has never, ever made sense to me, because the banks can create dollar credit. They can settle with dollar credit. So if the opportunity is there, if the risk reward makes sense, they're going to do this regardless of whether there's 3.5 trillion in bank reserves or 3.49 trillion. So I don't think it's just the banks don't have any money. I think it's that they're not willing to create the money. They're not willing to lend. And that's the bigger story here. Okay, so now let's go over to the 4-week T-bill. Now, you can see this should track reverse repo and Fed funds because reverse repo is the interest rate the Fed uses to try to put a floor on interest rates. So the top, they've got the discount rate. The bottom, they've got reverse repo. Kind of right in the middle, they have Fed funds. And so their idea is, well, we'll just do a reverse repo rate, add a few basis points under Fed funds, and that's going to put a floor on interest rates. Why? Because why would you buy a 4-week T-bill, in other words, lend money to the government at 4% when you could just take that exact same money and lend it to the Fed and their reverse repo facility and get 4.25? Doesn't make much sense, does it? So then you kind of scratch your head and you're like, okay, well, maybe this is front running the Fed dropping rates, but let's go over to FedWatch because we see, and I think this is probably even higher today. Are we at 78? Now we're at 80. Yeah, I would be very surprised because we had a good jobs numbers, and we're going to do a video on that later. But we're still at 80%, which, I mean, 1 month ago, we were at 74%, meaning they're going to pause. So 74%, they're going to pause 1 month ago. Today, 80%. So the chance of them cutting rates has actually decreased over the last month. But look at what has happened to the 4-week Treasury. It's gone straight down. And now it's, and where are we right now? 4.08. Let's look at reverse repo. Now, this is the reverse repo rate, okay? Which is the blue line, the blue dashed line here. That is the reverse repo rate. So the Fed has it right now at 4.25%. But starting, let's just say June, I mean, a month ago, it started to go lower. But then the odds, based on FedWatch, that the Fed would drop rates actually decreased. But as the odds of the Fed cutting rates decreased, the yield on the 4-week bill went down to where now we've got this pretty large spread. Now, has this happened before? Absolutely. Look at this. But it tends to precede a Fed rate cut, and which makes sense that it would precede it by 4 weeks, right? But what's odd this time around is, number one, we're seeing a corresponding big spike in repo usage at the Fed, and we're seeing the odds decrease of a cut, yet instead of the 4-week bill going right back to, let's just say 4.25%, or maybe a couple basis points below, it's continuing to increase the delta. So do I have a definitive answer as to what is happening? No. But I realize this is something you've got to pay attention to because things really aren't adding up. And if it was just a big spike in repo, okay, maybe that's explained away one way or the other. But it's not just that. It's also this 4-week bill doing the complete opposite of what you would expect based on the probabilities of a Fed rate cut. So another thing that we can kind of look into is what's happening with the overall economy. And we had a good jobs number. Now, I don't want to let the cat out of the bag because I'm going to do a video on that. But we had 7.8 million jolts with the expectation of 7.3. So job openings way higher than expectations. So you would assume the 4-week treasury would go right back to, where was the chart? It would, on this news, it would go right back to the 4.25%. But no. So what could this be telling us, the 4-week bill, in relationship with what's happening with this spike in repo? If it's not just simply front running a Fed interest rate cut, what it can be telling you is that there's more demand for collateral, because this 4-week bill is the pristine of pristine collaterals. So if there's more demand for collateral, why? Why would there be more demand? Why would there be a higher need for collateral? Because counterparty risk was increasing, and therefore, to get the liquidity you need as a financial institution, you have to post more collateral. And so what happens, I mean, there's a lot of variables, but then one of these primary dealers that rehypothecate the 4-week bill, or the treasuries themselves for collateral, they're going to see this and they're going to say, aha, here's an opportunity. So I would rather take my cash and buy a 4-week bill at, let's just say 4%, as opposed to 4.25%, and take the 25 basis point haircut, because I know that I'm going to be able to make way more than 25 basis points by rehypothecating this treasury, because I know demand is going to increase, because I talked to all my buddies on Wall Street and counterparty risk is increasing. You see how that can work? So just to make sure that we're all on the same page here, primary dealer banks, they see counterparty risk increasing, which means demand for collateral increasing. So they go out and they buy these things at 4%, because they know that they can rehypothecate them multiple times, and each time they take they charge a haircut, they charge a spread, and over the span of owning that T-bill, they're going to make more than the 25 basis points that they would have made by parking that cash at the Fed and collecting the 4.25% as opposed to 4%. So what this tells us is, there, especially when you combine this with a big spike in the Fed's repo facility, is counterparty risk could be increasing significantly, and dollar liquidity could be decreasing significantly. And this really plays into what has happened with the dollar. Or, another thing too, maybe the 4-week bill is sniffing out something that the Fed isn't telling us. That could be it, to where it is front running lower rates, but the information, the intel that would lead to a change in Fed watch just hasn't hit the wire yet. And it's basically kind of insider information. I mean, that could be it as well. And so we've seen the dollar really go down. I mean, we talked about this yesterday. And if we go over to the DXY, is it down again today? Down slightly, but we're still trading at a 96 handle, for heaven's sakes. So in my view, this is because of interest rate differentials. So you see this big move up. We had a decline, we have a big move up, but that's after Powell came out and spoke and said, oh, we would have cut rates, but we didn't because of the tariffs. So I think the market perceives this as, okay, as long as we're going to have these tariffs, Trump, then Jerome Powell could be higher for longer, and maybe he won't even cut. So this gives a little bit of a bump to the dollar, because now all of a sudden the probability of that spread decreasing between the ECB and the Fed, the probability of that deteriorates. Another thing that I'd like to add is the inflation rate came out today in the Eurozone at 2%, at least the ECB's kind of target rate they use. And it was 1.9. So they came out a little hot, which would lead you to believe that there's a higher probability they're going to pause. And now all of a sudden there's a little bit higher, meaning, there's a less probability they're going to cut, which would increase that spread and be negative for the euro. And you combine that with the slight increase in probability that the Fed is going to stay the same. And now all of a sudden you see that bump in the dollar because that interest rate differential, if it stays the same, would warrant the DXY at, let's just say, 102 or 103, as opposed to trading at a 96 handle. So I went over a video yesterday. We're just growing our email list. So Josh, can you put that in the chat? Because what I did is I put on a specific trade based on the signal that I'm seeing for the dollar. And I did this in my actual portfolio. This isn't like paper trading or anything like that. So I did a video explaining that, kind of my rationale. And so I call it the dollar playbook and how I'm trying to profit from the next big move in the dollar, whether that's up or down. And it's not necessarily taking a directional bet on the dollar. That's not it at all. What I'm doing is I'm basically trying to take the signal that we're seeing from the dollar's decline and put a bet based on what that signal is telling us and look at what has happened in history and looking at the charts as to when we have seen this signal in the past, what has that meant for interest rates and how should you position yourself to take advantage of that opportunity and possibly that asymmetric bet. So if you want to check that out, you can just, it's free. Josh will put up the link right there. We'll put it in the description. And it's not edited or anything like that. It's just a 20-minute video of me pretty much explaining the thought process and the history and going over the data and the charts and then going over the trade itself. All right, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market capitalism, and we'll see you in the next video.